Hey everyone, and welcome to this explainer. Today, we're tackling a topic that affects, well, pretty much every single one of us. Yet somehow, it's still shrouded in this bizarre amount of mystery and misinformation. We are talking about taxes. Specifically, we're diving deep into that widespread, almost paralyzing anxiety about what actually happens to your take-home pay when you finally land that well-deserved raise. Honestly, it's kind of fascinating how something so fundamental to our daily lives and our livelihoods can just be so wildly misunderstood by so many of us. Okay, let's dive into this. Here is the central mystery we are solving today. Will getting a raise actually cost you money? I mean, it's a question that literally stops people dead in their tracks. Just think about the psychology of this for a second. You work your tail off, you prove your value, and bam, you're offered a higher salary. But instead of pure celebration, this weird feeling of dread creeps in. This hesitation causes friction during salary negotiations, and it makes genuinely ambitious people second-guess taking on extra hours or going for that big promotion. We absolutely need to know, definitively, if earning more money can actually end up hurting your wallet. You've probably heard someone say it. Maybe it was a friend, a family member, or a coworker over lunch. I've entered a higher tax bracket. I'll lose money, right? Have you ever felt that fear yourself? Millions of Americans fundamentally believe this statement is just a fact of life. They walk around with this underlying assumption that moving up in income is somehow a financial trap just waiting to spring on them, like it's a literal penalty for their own success. But here is the reality. That is completely 100% false. No way around it. I really want to declare this right now as undeniably one of the biggest, most damaging tax myths out there. It's a misconception that actively holds people back financially. It keeps us from building wealth, and it introduces so much unnecessary stress into our careers. So today, we're going to break down exactly why it's wrong, and we're going to permanently remove that anxiety from your financial life. So what does this all mean? Well, to get why that myth is completely bogus, we have to look at the mechanical reality of the U.S. tax system. We operate on what is called a progressive tax system. Now, what does that actually mean for you on a practical level? It means that different portions of your income are taxed at different rates. The absolute key word here, the word that unlocks this entire concept, is portions. Not all of your income is treated equally by the government. It's actually divided up into slices. Think of a progressive tax system like climbing a giant flight of stairs. For step 1, your base income, the very first money you make during the year, is taxed at the lowest possible rate. For step 2, the next portion of your income lands on the next stair up, and that specific chunk of money is taxed at a middle rate. For step 3, only the very top portion of your income, the money that actually reaches that highest stair, is taxed at the highest rate. You only pay the higher rate on the dollars resting on that specific step, not the dollars sitting entirely on the steps below it. Which leads us directly to a phrase you hear constantly, usually said with a very strange mix of pride and sheer panic. I'm in the 22% tax bracket. People hear this phrase from their accountant or read it on a tax document, and they incorrectly assume their entire paycheck is suddenly being heavily taxed at a flat 22%. It's kind of ironic, isn't it? People are simultaneously super proud of making more money, but totally terrified of the tax implications. But if we remember our staircase, we know that applying that 22% to everything is simply not how the math works. Let's look at some concrete math together to make this crystal clear. Imagine you earn a total income of $60,000. Based on a simplified tax structure, the first $10,000 you earn is taxed at a nice low 10%. The next $40,000 of your income is taxed at 12%. Finally, it's only the amount you earn above $50,000, which in your case with a $60,000 salary is just that final $10,000, that actually gets hit with a higher 22% rate. And this brilliantly illustrates how your income splits up. When you break that $60,000 income down, it goes into 3 distinct buckets. Bucket 1 is $10,000 at 10%. Bucket 2 is $40,000 at 12%. Only that final bucket on the right, representing your last $10,000 earned, is actually touched by the high 22% rate. Notice something huge here. The vast majority of your money, a full $50,000 of it, is sitting completely safe and comfortable in those much lower percentage brackets. Because of this whole stair-step structure, your average tax rate is much, much lower than 22%. This is a vital distinction to lock into your brain right now. Your official tax bracket is just a label for your top tier. It is absolutely not the same thing as the percentage of your total income that actually goes to the government. Treating those two numbers as if they're the exact same thing is the exact mathematical error that causes so much unnecessary panic. So let's put this into a real-world scenario to bust this ultimate myth once and for all. I want to set up the specific situation for you. Imagine you're working incredibly hard, putting in the hours, and your base salary is sitting right below the edge of our imaginary tax bracket at exactly $49,000. You're comfortable, you know your take-home pay, and you are taxed completely in those lower brackets. Then, great news. You absolutely crush a major project and your boss pulls you aside to give you a $2,000 raise. That's awesome, right? But almost instantly, your internal monologue starts racing. That extra $2,000 pushes your total income to $51,000. It bumps you just over that $50,000 threshold we talked about, straight into that new, higher 22% tax bracket. The panic sets in. You start asking yourself, wait, did I just ruin my finances by succeeding? Is this raise actually going to make my paycheck smaller? So the crucial point is separating the myth from the reality here. The myth tells you that this new, higher tax rate now applies retroactively to your entire $51,000 salary, eating up the whole raise and leaving you with less money than when you were making 49 grand. But the reality? Only the $1,000 that actually spilled over that $50,000 threshold gets taxed at the higher rate. The previous $50,000, it's completely untouched by the new rate. It stays perfectly safe at the lower rates. Therefore, your overall take-home pay absolutely still increases. You keep the vast majority of that raise. I really want to state this as firmly as possible. Never turn down a raise because of taxes. You never, ever lose money simply by crossing into a higher tax bracket. Refusing to work overtime or turning down a hard-earned promotion because you're scared of a new tax bracket is essentially choosing to be poorer based on a math error. It's a tragedy of financial literacy. And now that you know how the steps actually work, you literally never have to make that mistake. Understanding this math actively empowers you to make much smarter financial choices. It's a real game changer. You can now operate in your career with absolutely no fear of earning more. You also start to understand the incredible power of retirement contributions, because putting money into a pre-tax 401k can cleverly drop your taxable income back down a step on those stairs. You can better estimate your actual tax bills instead of just guessing, and most importantly, you can easily spot and ignore all those toxic tax myths floating around online. Ultimately, the whole shebang boils down to the critical difference between your marginal tax rate and your effective tax rate. Your marginal rate is simply the rate on your last dollar earned. Remember that top step of the stairs? In our $60,000 example from earlier, your marginal rate was 22%. But your effective rate? Well, that's the actual, much lower average percentage you paid across your entire income. If we do the math on our example, the tax on that first 10 grand was $1,000. The tax on the next 40 grand was $4,800, and the tax on that final 10 grand was $2,200. Add all that up, and your total tax bill is exactly $8,000. Now, $8,000 divided by your $60,000 total income means your effective rate was actually around 13%. Knowing the difference between feeling like you pay 22% and actually paying 13% is absolutely crucial for smart investment and retirement planning. As we wrap up, I really want you to remember this core takeaway. Tax brackets are not designed to punish you for being successful and climbing the ladder. They just clearly determine how different portions of your income are taxed along the way. So, I'll leave you with this provocative thought. If so many of us are entirely wrong about something as fundamental as how our own paychecks are calculated, what other major financial decisions are you making right now based on online myths? Keep questioning what you hear, keep digging for the actual math, and I will see you in our next explainer.